All right, hello everyone, welcome back. In this video, we're going to talk about liquidity. So we spoke about liquidity briefly in the previous chapter, but I want to go more in depth on this and I want to show some more examples and present it to you on the charts. Now, in my opinion, when it comes to technical trading, liquidity is one of the most important things, and it's surely what's going to set apart the winning traders and the losing traders. The reason being, because if you don't understand the concept of liquidity and you don't understand why the market is doing what it's doing, you are going to hit more losses, first of all, and generally not understand to the fullest extent what the market's doing and how you should be trading it. So, when we talk about liquidity, we are generally referring to orders in the market. Okay, and as we know from the Forex Foundation section, we have multiple market participants. We have retail traders, everyday people trading the financial markets like me and you, and then we have institutional participants like banks, hedge funds, and trading institutions who are using massive amounts of capital. Now, we spoke about that, and we spoke about the fact that the institutional participants are trading with such large quantities of money that they can actually move the market. Okay, so what they actually do is push the market into a certain zone to then send it the other way. Now, might be a bit confusing right now, but I'm going to break it down. So we know that they're trading with huge amounts of capital. Okay, they're trading with amounts of capital to the point that they do not have enough liquidity or orders in the market. Okay, to actually fulfill their buy or sell position. So, for example, if we take a look at this area here, we have a big consolidation phase. All right, we've got this sideways action forming loads of these equal low points in the market at the bottom of this downtrending move. Generally, a lot of people would be buying in this point, ready to actually take the market higher. Okay, and when we see this move here, this is obviously going to entice people more so because at one point this would have looked very bullish. Now, that's the retail traders accumulating that. Okay, now we know that this is a good place to buy from. The institutional traders, the institutional participants are also looking at this as a place to buy from. However, their orders are so large that they can't just go ahead and buy, say, billions of dollars worth in this point because there's no one there to sell them to them. Okay, now when we want to buy or sell a market, there's generally always going to be someone on the other side selling. There's going to be enough orders going towards us, going to us, especially in the Forex market. Now, this can be a problem in some stocks where there's no one on the other side of your order to fulfill it. So if you're selling, there's no one to buy. And if you're buying, there's no one to sell. And that causes slippage, which obviously is not a good thing. It's basically going to mean you can't close your trade when you're trying to close it, and it's going to end up closing at a worse price. So same kind of concept, but for market participants with huge amounts of capital. There's not enough sellers in this point to sell off the orders to the institutional participants. So what they have to do, and what they actually do, and this is where the liquidity comes in, is push the market, okay, underneath the stop losses of these retail traders. Now, we know general retail education. You've probably had a general retail education before going onto this course. We know that the general thing is buy with a stop loss under the low. Okay, so when they see consolidation like this, a lot of retail traders will be buying with a stop loss under the low. So let's say we buy this pin bar, we're a retail trader, we put our stop under the low of the consolidation and we're looking for this target. Okay, now all looks good. We all very happy with our movement. And then before the market actually breaks out, what it does is come down, push through our stop loss, trigger us out for a loss, and then the market flies. Okay. Now, if you're a bit more of an experienced trader, you've been in the markets a bit longer, you may have witnessed and experienced this exact thing happening more than once, and it's probably really annoyed you. Now, what I'm trying to do is make you understand why that happens. So the buyer thought he had a great position, stop under the low, nice and safe, and then the market comes through, just taps into it, probably makes him think, all right, the market's going to go bearish, and then nope, it flies, and it flies with absolute strength. Now, the reason this happens is because this point here is where the market needs to be driven into by the institutional participants to trigger their orders. Okay, so we've got retail accumulation where we know that retail traders are buying and buying and buying in this area. We know then that the retail stop losses are going to also be beneath that level. The retail accumulation is this area, so we should bring that forward. The retail stop losses are just underneath this level, okay, because we know that pretty much 90% of traders are going to be using that stop loss under the low approach. So I'm just going to mark this on as a red line. So the retail stop losses are just there. And then we know that we've got these huge market participants with huge orders to put on. They want to buy, but they don't have enough sellers selling to them to fulfill the quantities they need to fulfill. So what they'll do is actually drive the market lower, tap into these stop losses. And then what this does, right, this is how it works. When it hits the stop loss, when price hits the stop loss, everyone who is accumulating here with a stop under the low has now been liquidated. So their buy positions have been sold into the market, all right? When the market hits this level, all of these buy orders are sold. And what that allows the institutional participants to do is buy all of those sold orders from this point, okay? So that's how it works, and that's what we mean when we say liquidity. So liquidity refers to the orders, and when we get a liquidity run like this, we are basically watching all of these buyers sell their positions at the stop loss level to the institutional market participants. And now that explains why we have this huge rally, okay? Because this is the area where all of that capital is being injected into the market, right? The billions of dollars or the hundreds of billions of dollars even from the institutional market participants. Does that make sense? So they've got the power to drive the market with the orders they have. So they drive it down ever so slightly, trigger the stops, get all of these sellers selling off to them, and then they buy up all of those orders, they buy up all of that liquidity, and the market shoots up, propelled with a lot of strength and a lot of momentum to go and fulfill the targets that these guys were looking for, but now they've missed the boat because they took a loss instead of a win. Does that make sense? And that is why liquidity is so important, because if you're a retail trader and you're trading with the retail traders and with the retail education, you're going to get burned like this so much. It happens loads. You see it loads and loads in the market where we have either accumulation and then a stop hunt before it flies, or distribution. So, at the top of a move where it will distribute, getting ready to actually short off into the market. And then we get a stop hunt out the top and then it sinks. All right. And that is why it works. That is why it happens. Now, this move here is a trade I took on my team. We triggered this from 2,150. Now, if we just look at where 2,250, sorry. So 2,250. Now, the reason being, demand zone, key level. This is a trade I actually took with my trading community, and this is a while back now. This is an October trade, but you can see understanding liquidity allows you to actually get the good entries. Okay, because I saw this accumulation, I knew I wanted to buy from around this point, but I knew that all of these equal lows. You can see, 1, 2, 3, 4, 5, 6. Well, loads of equal lows in the wicks. They don't hold up, right? Before the market moves, we are going to go through them. So if we can identify important levels around that line up with that, so we can see retail accumulation, and this is the importance of key levels as well. You can see right now we're not really at a key level. The lows of the wicks, all right, at the 50 level, sure thing. But the demand zone is down in here, all right? So we've got a demand zone. We've got that 250 key level. And we are, of course, in an uptrend, so we are looking to buy. And then we see all these equal lows. So what we can assume with the education that you've been taught in this course, focusing on supply and demand, key levels, price imbalances, and now liquidity, we can assume that the market is going to come down, take out the liquidity under these equal lows, tap into the key level, and then bounce. And that is exactly what I did with my team. We brought in from here, stop under the low. This is a hypothetical move. I can't remember how big it was. Probably around this trade. I think we went with a 35 pips stop, just kept it under the low. We took it all the way back up into these highs, which became the sell zone. Now, if you see this actually play out, we made a lot of money in the space of a few hours. It was just in one day. Yeah, there you go. You can see that GBP AUD absolutely flew after fulfilling that liquidity. And now this is the kind of trade that you should be looking for. Okay, trying to break you away. I mean, this is if you have an education. If this is your first education, then you're set up better, to be honest, because you don't have to go through the BS. But if you're a trader who's been trading the retail education ways, you're the person that's buying in this zone. Now you know not to. Your entry should be where your stop loss was, all right? Your entry is going to be the stop losses of retail traders. We are essentially looking to mirror the institutional participants. We want to follow them as much as we can, because where their money flows is where the market flows. So if the institutional participants are using retail stop losses as their entry, then we, even though we are retail traders too, are going to find out how we can also use retail stop losses as our entry. Because what's that going to do? It's going to give us precision, And not only precision, but what it's actually going to do is, because where the institutional money is injected into the market is where the big move forms. All right. So if we get in down here, we don't have to wait. Like, as soon as this trade was triggered, a few hours later, it was at a take profit for 6.4R, which is essentially 13% if you're at a 2% risk trade. If you're 1%, 6.4% in what is that? 1, 2, 3, 4, 5, 6, 7 hours. Well, 6 hours. So you can see that if you understand the liquidity, if you understand where to buy in line with these institutional players in the market, then you can get these amazing entries. All right. So that is GBP AUD. What I'm going to do, I'm just going to have a browse around the charts and show you a few more examples. I'll try out some different time frames as well, just so that you can see how often liquidity plays. Now, it might not become so evident right now, but it works on every time frame. And if you are, of course, focusing on the lower time frames, you're going to see more examples. But on the higher time frames, we do get examples as well. So I can immediately see one down here. See how it's pretty much exactly the same move. So the move we just looked at was this one. I'll box it out. A new move to consider would be this one down here. Okay, so see how we get equal lows, equal lows, equal lows, and then we get this big push down, and then the market flies. So if you can be looking down here for your entry, which, okay, that correlates quite nicely with these demand zones as well. So if you would be looking at these demand zones down here, now this isn't a trade I took, so this is kind of a little bit of improv, but I'm just showing you the concept. So had you been looking towards potentially the 750 key level, which sits in that demand zone, you could have looked at that, all right? So we get the push down into it. We get that bullish engulfing confirmation. Could very well be your entry. 60 pip stop or so. Take the market back into previous supply zone. See the precision it taps into? That's a 4.3R move, which you could have caught quite quickly. Hypothetical, but just showing you the concepts of liquidity. We get this consolidation, and consolidation should generally never be trusted. The only reason that you would go ahead and buy a consolidation is if it breaks out the top and then comes back in, because that's generally then showing a shift in structure, okay? But when you see these consolidation phases like this, you generally cannot trust them too much, because they are likely to go and have that stop hunt where the institutional players want to get their orders in. So they wait for all this accumulation, they wait for all the stop losses to form under this level, and then they're going to drive it into that, get the retail traders to sell off their orders to them, and then bam, the injection of money, the injection of liquidity flies up into the market, their orders are fulfilled, and that is where we get the fast, sharp movements. So great. Yeah, we see a selling example here as well. So this one, maybe on the higher time frames, could be a good example there. Yeah, brilliant. So you know how I just drew that zone on? We've essentially got, high point, equal high, equal high, equal high, equal high. And then before the market begins moving down, which obviously is all the way back down here, we are going to get that stop hunt. So you don't want to be selling at general resistance levels. You want to be focusing on more than that. Now you can see that, yep, this retested the supply zone, but this has come up a little bit more. It's not always entirely evident where it is. It's going to need some digging. Obviously, I'm not here to analyze the whole movement in this video. I'm just showing you the concepts of liquidity. But you'll see that all these equal highs, they do give way. And it often happens with equal highs or equal lows in the market. They are going to give way one way or the other before the market actually begins its movement. So what you need to be able to do, and what you need to learn to do, is read into the liquidity. And now what I mean by that is, when you're looking at a consolidation phase, be it accumulation or distribution, think about what's going on right now in time, okay? Think about where the retail traders are placing their orders. Think about where the institutional participants are going to come in and sweep those orders for their movements. Right, so there was a good example on GJ quite a while ago now, but it's absolutely textbook move. So I'm gonna have a hunt for it. Okay, here it is. This is a movement that I also took with my team. This was long ago, August 2020. But this move, I always refer back to this move because it's so textbook and it's so clear to see, and a great example. This move was a GJ long that we did. So we brought GBP JPY. Now I'm going to show you where we brought and why. So what do we see here in the market? We see an uptrend, higher highs, higher lows. And what we've got is these two equal lows in the market. So instantly that's a red flag to me. Why is that? Because liquidity, okay? Equal lows generally means we're going to get pushed through before the market starts going. because equal lows means retail buyers, and retail buyers means retail stop losses. So stop loss under the low. I usually use this little red box to refer to liquidity, by the way. Now that's obviously a little stop loss box, and that's generally what I'll use to just mark out areas where liquidity is. So we know the market's uptrending. We've got these demand zones down here. The market is looking bullish. It's probably going to go higher. We know this much, but we do have these two equal lows in the market. What do we also have? We also have this little demand zone down here in the 138.250 level, as you can see, just this little pocket in the low of the move. We've got this demand zone, all right, in there. Key level, 138.250. So another confluence. And you can see how it's all lining up, yeah? We've got a demand zone which hasn't been tested. We've got a key level which hasn't been tested. And we've got liquidity sitting above. So we've got liquidity there, stop losses there, that we know the institutional participants are likely to drive the market through before it goes. So we brought from this level, okay? I can't remember where the stop loss was. I know that this one played around a little bit. But obviously, this is the idea more so than the actual trade setup. Demand zone, key level, liquidity under the low. Now what we do, we come down, trigger the entry off the key level very, very nicely. I think this one came back down to tap it another time. Okay, there we go. So yeah, no, it didn't even tap into it. So as you'll see, we tap the key level right here. Since that, we never came that low again. Now that was the trigger for the move. And as you can see, it played out to perfection. All right, and I think this market went considerably higher. We got out around this move after this big bearish engulfing candle is when we left this move. But I think it went considerably higher as well, if I remember correctly. Yep. So you could have held it out longer. Obviously, saw a big reversal. We have been very, very extended. Obviously, that doesn't mean too much most of the time, but when you see a big reversal candle like this, you may want to get out. Obviously, 4.6 or so percent on a movement, or 9.2% or so is definitely not bad. So that's another great example there of how you actually read into the market, okay? And it all comes back to the normal focus of demand zones, key levels, and all these other things. Because yes, we know we want to buy GJ, and yes, we've seen these two lows come in the market, but we know that there's stop losses under there. And we also then pair it up with what we follow, which is going to be the demand zones and key levels and price imbalances. So we've got a demand zone, a key level, and a price imbalance under this point here, paired with the fact that there's these two equal lows. So there's obviously retail stop losses under there. So we want to look for the institutional move, which is going to be using the demand zones, the supply zones, the key levels, right? And if we do that, we're going to get much more pinpoint trades. Best thing about these, to be honest, aside from the fact you're going to avoid hundreds, if not thousands of losses by understanding this liquidity concept. Like imagine being a buyer here or here. This is going to happen. You're not going to know why. But now that you understand liquidity, you will know why. Best thing about these moves, as I was going to say, is that they trigger on key levels almost to precision. You saw GBP AUD, now you've seen GBP JPY, trigger off those levels to precision. And the best thing about them is, as soon as they trigger, they fly. They absolutely fly, because that is where the institutional money is being injected, all right? Sat in this market for what? Is this the 4-hour chart? You know, maybe a day while it accumulated down here, and then it absolutely flew. So over a couple of days, you can make, as you just saw, around 9% profit if you're risking 2% per trade. And I mean, could have got a more pinpoint entry, better stop loss. Obviously, I'm just showing hypothetical positions, but even on a hypothetical position, which we cut early here before this whole move, that's 9%. So that's insane. That's pretty much a month of trading done. So there we go. I'm pretty much going to just cut it there for this video. You understand the concept now, how to put it all together. I may make more liquidity videos in the future. I may even make a whole liquidity series, because I think it's so important and there's a lot that you can discuss. But I do believe the concept here has been covered very well, and you're probably going to be able to understand this a lot more now. So remember, with all of the technicals I've showed you, liquidity is very, very key. It's very crucial that you understand why the market is doing what it's doing. Do not trust the equal lows. Do not trust the consolidation of the retail trader, and look for the zones, the key levels, the imbalances around those levels that the institutional participants are going to push into before the real moves form. All right. Another thing as well, just on this movement, is I actually posted on my Instagram, what do you see here when the market was here? Okay. I posted this up because I wanted to see what people saw. I saw this as really bullish because I understand the liquidity, the demand zone, the key levels. But you know what answer I got a lot, which is another great thing of you understanding this liquidity now? A break retest, right? People were bearish on this because they saw two lows broken and retested. So what does that mean? We're going to have sellers coming in here as well, which is even more liquidity for the institutional traders when these sellers get wiped out and end up selling off their orders to the institutions on that push up. So hopefully now you'll see this in the way that I saw it, with the key levels in the demand zone and the liquidity, rather than just following those basic principles and seeing this as a break retest. Because I can assure you, it is not a break retest. All right. So thank you for watching. Hopefully you've enjoyed this video. We are going to move on and look at a couple tools now: Fibonacci, moving averages, just some extras. Liquidity, to be honest, is the key video for this chapter. The other things we are going to now show you will help you to build your confidence and confluences when you're finding trades in the market. But this one, I'm really putting the time to study this one, okay? And as mentioned, liquidity works on all time frames. Doesn't have to be the hourly, doesn't have to be the 4 hour. It can be the 5 minute, can be the 15 minute, can be the daily, can be the weekly. It is relevant and present everywhere. So do your homework, dig into the charts. To be honest, it's a really fun and a very, very progressive thing to do, to see this actually happening in the market. All right. So studying this is going to be a lot of fun. Just seeing where we get these consolidations, these equal highs, these equal lows, and then the stop hunt. So go back, use past price data. Remember, you can always use the replay tool here to go back in past price data and test out your methods. All right. So make use of that. Make use of this education. If anything, to be honest, if anything from the technical part of this course, you need to understand liquidity. All right. So thank you for watching. I'm actually going to cut it now. I've been going on quite a bit. Hope you've enjoyed, and I'll see you over in the next videos.